What's going on, everyone? Jeff here, back with another video. I want to talk today about DraftKings, ticker symbol DKNG. This is a huge investing opportunity, I do feel. Before we get started, guys, this is the 1-year chart on DraftKings. There is some things we need to talk about. This is a very non-traditional way of becoming publicly listed. DraftKings actually became public through an acquisition. We're going to get into that in just a moment. So back here in 2019, if you would have invested into quote unquote DraftKings, you actually would have been buying into a different company you probably didn't even know was affiliated with DraftKings at that time. But as you can see, the amount of growth that this stock has shown in 1 year's time has been remarkable, seeing highs of over $44 per share. Now is ticked back a little bit, currently trading at $37.55. So what I want to do, guys, I want to start coverage on DraftKings. This is a stock I want to start keeping a close eye on. I believe there's a very, very big future here. And as we all know, I think the real thesis, the real idea behind this stock is that right now during COVID-19, there is not a lot of sports to be gambling on. But as sports start coming back, this platform and this company really has a golden opportunity to become quite big. And I will also make the counter argument that this stock is already very, very overvalued as well. If you look at it from a fundamental standpoint, it is very, very overvalued right now. But regardless of that, there's a lot of companies that are still worth our attention, our time, and some analysis to make good decisions about. So before we get started, guys, I want to just jump right into it. Do me a favor, make sure to drop a thumbs up on this video. I appreciate all the support. And make sure to subscribe to the channel if you have not done so already. Alright, so let's start here. What exactly is DraftKings? This is an American daily fantasy sports contest, okay? And it also allows sports betting. Pretty much anybody that wants to sign up for the app. It allows users to enter daily and weekly fantasy sports, bet on the players and teams that they wish to gamble with, and of course walk away making some money. So it has become pretty much the easiest way to gamble on sports online. Obviously, as we all know right now, during the COVID-19 pandemic, a lot of sports are shut down. I know the NBA shut down. Just recently, the UFC started having events again, and it's still on the rocks whether some of the other sports are going to return. But regardless, a day will come when sports will come back, and you can bet that this platform will start being used a heck of a lot more. Also, the app has a 4.8 rating in the Apple Store. I don't think it's going to make any difference in the performance of the stock, but keep that in mind. Little things like that do matter to people. How good and how user-friendly is the app? And apparently it gets a very, very high score. I personally do not use DraftKings. It might be something I will look into once the NFL and NBA seasons come back. But for now, I have not used it. I do have some friends that have used it though. Now, real quick, before we move further in the video, I do want to talk about how it was DraftKings became public. Okay, it was not a traditional IPO. For those of you that don't know, I have several videos covering IPOs. You can go back through my video catalog if you'd like to become more educated about that. However, let's talk real quick about what an IPO is. That's an initial public offering, and this is just the process of offering shares of a private corporation to the public in a new stock issuance. Public share issuance allows a company to raise capital from public investors. And you've seen this, I'm sure, many, many times over the past couple of years. I can think of a few right off the top of my head, like Beyond Meat, Uber, Lyft, CrowdStrike, Zoom Media. Several of these different companies have become public over the last year or so. And a company picks a date, they file all the paperwork, underwriters have to write up an IPO, a lot of effort, a lot of things have to be done in order for this to take off. And then a date is set and a company goes public and their stock is now trading on an exchange. That is typically how an IPO works. That is not how DraftKings became public. Let's talk about exactly how that happened. DraftKings actually went public in 2020 in April of this year. They managed to go public on the NASDAQ through a blank check company, Diamond Eagle Acquisition Corp., which that company went public in 2019 at roughly $10 a share. Now, it's actually been called a reverse merger, okay? Because Diamond Eagle Acquisition Corp. actually became DraftKings, and that is also the ticker symbol. So after announcing in December that it would merge with DraftKings, shares moved as high as almost $19 as investors waited for the combination to be approved. On its first day of trading, DraftKings stock closed up 10%. I know there was a lot of speculation. There was probably a lot of negative speculation going into this reverse merger because the company listed through a blank check company, which it announced in December. A few of the positives, it did avoid the market turmoil that has come with the coronavirus outbreak that has stifled so many other businesses globally. And also, it did manage to dodge a lot of the problems that come with IPOs. For example, when underwriters sell large sums of stock, usually see big sell-offs in the stock price. And IPO companies typically are just kind of kicked around, okay? They get traded up and down a lot the first couple of years before they really find stable ground. Of course, there's always a few prime exceptions. Just wanting everyone to understand, they did not have a traditional IPO. It was a very unconventional way of being listed public, but it has been very effective. And since they've been trading on the market, the stock has performed very, very well. Now, one of the big perks about DraftKings is they have many different avenues to make money. And I'm just going to re-emphasize this. Yes, there is a big threat to DraftKings right now while the coronavirus has kept sports mostly down, okay? But again, the whole idea here, you have to take some risk to make any reward, is that sports will recover and this platform is going to start being used a lot more. Let's talk about a couple of the ways that DraftKings make money. First off, they make revenue from daily fantasy sports, and that is the difference between the entry fees collected and the amounts paid out in prizes and customer incentives. So you can think of it as a transaction palace. 2018, after a Supreme Court ruling, DraftKings added not just sports betting, but online casino gambling, which is, of course, called iGaming. So when it comes to sports betting and online casino gambling, their revenue amounts to the difference in the amount of cash paid out compared with how much players bet. And in addition to its revenues from games and its transactions, DraftKings also sells ads on its platform. The company also says it records the various incentive it offers to customers, such as loyalty program, as reductions to revenue, and that such costs are very seasonal. And of course, you can also say very dependent on the amount of sports that are being played at the time. So first, let's jump over and take a look at their first earnings report. And that took place on May 15th of this year. They had a miss on EPS of 2 cents. They missed on revenue by $15.83 million. Now, of course, when you look at the stock chart, it didn't seem like it slowed the stock down at all. But here is the counter argument why DraftKings is probably very overvalued right now at this point. Their first public earnings report was nothing to brag about. And like I said, a lot of that probably has to do with sports here in America being shut down. And just to elaborate a little bit more on that, it had a net loss of $68.7 million or 18 cents per share in the first quarter. That was much wider of a loss than $29.6 million or 8 cents per share posted in the year earlier. But they did mention that revenue rose 30% to $88.5 million from $68.1. So the company is definitely growing, but their losses are also widening. They do have an efficiency problem. However, I've seen this many times before with many different companies. You know, while your revenue is growing, so is your losses. And it does take a while to get stable and be really strong fundamentally. Regardless, a lot of companies and stocks do tend to grow during this period of time. Just keep in mind, all the risk is on the investor's hands at this point. With losses like that, you do have to sit back and say, this kind of company is very overvalued. This is also considered a controlled company. A co-founder and chief executive, Jason Robins, possesses roughly 90% of the voting rights through a dual share structure. So I do want to mention this. If you are the type of investor that likes to have voting rights, it's not going to do you a lot of good with DraftKings, because a Class A stock will trade publicly and carry with it 1 vote per share, but the Class B shares that Robin holds, however, won't trade publicly, and they'll grant him 10 votes apiece. So this is considered a very controlled company, okay? And in terms of sports betting, since the Supreme Court allowed such activity, 21 states and Washington, D.C. have legalized it in some fashion, though only 9 markets are currently operating. DraftKings estimates the total market for online sports betting could eventually range from roughly 18 to 23 billion as some states launch their online sports betting programs and other potentially legalize the activity. Let's also touch on the online casino gambling is legal right now for 4 states. That's Nevada, New Jersey, Pennsylvania, and West Virginia. So that is a source of revenue and income for them. But they do say that it's less likely more states will legalize online casino gambling. According And according to Tip Ranks, DraftKings is listed as a strong buy with a high price target of $60 per share and a low of $25 per share. The last few companies that have come out and given analysis to DraftKings have all been buy, so all the coverage on DraftKings is bullish right now. I think it's the long-term perspective and also the recovery on sports. Cannot promise you that this stock is going to run to $50 or $100 a share soon, but this, in my opinion, would be a very good long-term investment, and you might be smart to take a position now. Alright, so let's put some final analysis on this video. Is DraftKings stock a buy? Yes, but I don't necessarily want you trading this stock very much. This is more of a long-term perspective. It is probably wise to start taking a position here. Like I said, really concentrate on the long-term view. As sports recover, this platform grows, and of course, as more states get legalized for sports gambling, there's no doubt this platform is going to grow very, very much, and it is also prime acquisition material for maybe even a bigger tech company. So like I always say, do not go all in on one position. Maybe there's a couple stocks you could do that too. I would definitely not go all in on DraftKings because it is still very risky at this point. But I think the momentum and the coverage and really the long-term thesis is all sitting there. Expect a little volatility, but all in all, I think DraftKings is going to make a very, very nice long-term investment. Definitely leave yourself some room to cost average down a bit more. And keep in mind too, I will be covering this stock quite a bit more often. I have plenty more videos coming. Drop a comment, tell me your thoughts and opinions on DraftKings. What do you think about the stock for long term, short term? Where does it go from here? I always enjoy hearing that kind of stuff. Thank you as always for watching the video, and have a great day.